And every person is sort of, on both issues, has their own place where they are on the spectrum. But, sorry, that's a long way of answering your question, but it was a good question because it's one of the main points.
So you don't see them having to increase their interest rates because of this extra step in investment?
Like going through us, you mean?
Yeah, exactly.
Definitely I see, in a perfect world, either we would be absorbed into a JP Morgan or partner with them in a way where either we get cut out of the equation or something, because they can't assess risk like we can in this field. They don't have the appetite for doing small, for them, you know, $500,000 loan or investment or $1 million investment is just not exciting. They move in chunks of 10, 20, $100 million. And so the banks think and work on that basis, and the microfinance institutions don't have the connections. And so in a perfect world, there has to be an intermediary. If not, we get absorbed into them to cut out the middleman, because there's just, the big banks only want to deal with the largest of the largest microfinance institutions, and there's 5,000 to 8,000 of them that would just be ignored if there's not organizations like ourselves that are playing that intermediary role. But yeah, and I suppose we are an intermediary, a middle person that adds to the, we have to get our couple percent to pay, you know, my salary, whatever. But yeah.
You touched a little bit on hyperinflation. Do you guys just try to generally stay away from countries where inflation is very high, or do you have a sort of a different strategy for dealing with those countries?
That's a great question. Generally, yes. We do stay away from countries that are hyperinflationary. It's very difficult to predict that happening. When it is occurring, we will limit or stop making further investment. We will typically, you know, inflation has sort of two sides of it. I mean, from our perspective, we will typically, pretty much all our investments are in dollars, so we're not going to be affected a whole lot by currency devaluation. To the extent that our investments are in local currency, we'll hedge that. So that is okay for us, but that doesn't minimize the impact on the micro entrepreneur and their business and their loan with the microfinance institution, because on increasing with hyperinflationary rates, then they're constantly having to reprice their product to be able to cover their liability, which is this loan for the microfinance institution. And one of the things we will look at in countries where there isn't the risk of hyperinflation is we'll see what the microfinance institution is doing to provide some sort of, it's almost like insurance to the micro entrepreneur. So they'll peg a standard devaluation of their loan over the time to the micro entrepreneur. So it's sort of a sharing of risk in that situation if that occurs. Does that answer your question?
Yeah.
Okay. How much time do you spend in DC?
Well, unfortunately, right now not physically, obviously, but I've been chained to my desk about the last 6 months trying to get out the new fund. Our investment team, which I was on, they probably are out in the field about a week every 5 weeks or so. Which is a good amount. I mean, it's not too much.
But are they usually like small trips, or are there ever like really, really long trips?
6 days, 6, 7 days to do due diligence on one deal. Now we'll try to parlay two together if we can, so that we can minimize costs. But definitely not usually more than 2 months, 2 weeks.
Can you explain the types of operating expenses that you were talking about earlier, the higher operating expenses? I'm just having trouble understanding why the funds that you work on are arranging the organs while people that are getting the loans send over the $2 a day.
So the operating costs literally are, so if you think of a microfinance institution, their business is lending money. So they have a revenue stream, which is the interest on the loans that they give out. They've got a cost of borrowing that capital. There's three components. Their costs are basically three costs. So the first is the cost of borrowing that capital to lend it out. So that's them paying us for our money that we lend them. And that is anywhere from 8 to 10%. They have a cost which is the write-offs or the losses that they occur. So the loans that they extend that go bad, that generally is 1 to 2%. And then there's everything else. So operating costs are everything. So that's the salaries of all loan officers, the branch managers, the IT systems, HR, headquarters, all of whatever development is being done for new products, all the back office administration for all of the loan portfolio. So the write-offs are what the write-offs are, and the market is where it is in terms of pricing for debt. What they have control over is how efficient they're running, really. And so that goes part and parcel with what they can charge on the loans that they extend. And then all of that's always market driven. I mean, they may need to charge 32%, but if the market's paying 28, then they need to charge 28.
So do the organizations that borrow from you charge one rate for everything that is the loans that they get out and operating expenses, or?
They pay out, so the rates that they get on their loans that they extend to the micro entrepreneur typically are all over the place. Not all over, but they have different products that have different pricing. Not much different than what you would see in a financial institution here in the States, that a car loan is priced at, within this range depending on your credit quality, and a mortgage is based, between this range depending on your credit quality and the price of the value of the property. They have the same sort of things. Like they'll have each product, for instance, there's a microfinance institution that is targeting a rural, ag-focused geographic population. They will have one loan which is for corn, and it'll be starts in whatever, April and goes through August, if that's what the growing season is, and it'll be a factor. There'll be a loan calculation that'll be a factor of whatever the input costs are and the growing costs are for corn, and it'll have a certain pricing on it and have a payment structure that'll be a payment at the end, versus financing a milking cow will be a different thing. It'll be have payments every week, and because the farmer is taking milk to market every week, or and have a different interest rate because there's more of a collateral with the cow than there is with corn. And so it's all over the place. I mean, each microfinance institution